Wow, what a way to start a Monday. And Mondays, they are notoriously known to being somewhat of overreactive type of days in the trading market. Well, we got news on Friday of last week, I believe it was, or over the weekend about DeepSeek, a new AI tech. And it really did put the kibosh on the whole AI trade, at least for now. We don't know if this is an overreaction or not. But in today's Stock Market Brief Show, I do want to map out some key levels and some very interesting things that I'm seeing take place in the markets. I'll go over some individual names that are setting up here and wrap your head around what the market's pricing is for his risk, because this week is just getting started and we have a lot going on still in the days ahead. Let's get into today's show. Okay, everybody, welcome back to the show. First and foremost, this was the chart that we shared on the last Stock Market Brief Show. It's the SPX Commodity Trading Advisors Positioning. If you want to go back to that episode and watch it, please do. You can see that we're in the negative. Well, after even today's wicked sell-side activity, what do you notice here? Well, we're starting to see an uptick moving into positive territory, meaning CTAs are potentially joining in to the rally. Now, what I find so interesting here is that in August, about 19th, they were also under this zero line over here, and they weren't participating in the rally. So when we pulled up this chart, we looked at this entire rally take place and CTAs were completely absent. And it wasn't until they started turning back around is when they started to participate. But during that time, what happened? Well, we saw some massive volatility to the downside, retracing about 50% almost of this big shot rally. And what I found so interesting on this big shot rally where they didn't participate, today we came in just at about 50% of a retracement already on this news about DeepSeek. Now, we still have a lot going on in the markets up ahead, which we'll discuss. But I wanted to call that out because this is overall still a healthy market despite seeing a big shot in reaction to news. Why so? Well, let's take a look at ES, right? This is just a pure chart here of the S&P 500 E-mini futures. And what do you notice here? I'll give you a second. There's red and green lines on my screen. Well, the red line here, then you have a red line and a red line, a red line and a red line. And what we're calling out here is you have a series of lower highs and then lower lows. But up until recently, what do you see? You see a higher low, a higher high and a higher low. So we came way down here to about 5940-ish, 5950-ish, and we started to find some support. So as it stands right now, the trend of these lower highs and lower lows have been reversed, and we just put in really our first higher low of this rally. Now, that means that this low becomes increasingly important as we progress forward. So keep an eye on that lower low as well as obviously that higher high. And NQ, you can see a very same situation. You have the higher high. And today, did we actually crack down through this low? No, we had massive sell side in the pre-market and after hours session going into this week. And you can see that we came down and almost came and crossed it, but we had a nice rally from these levels. So this low is going to be critical. But as it stands right now, what is that? That is a higher low, and we have a higher high, but we're in the midst of some pretty strong volatility. If you take a look at the 11 sectors that make up the S&P 500, tech was the laggard. No surprise there, as NVIDIA is such a huge weight. It's the number one holding in the XLK. It was down 4.9%. Utilities was down because some of the utility names had really strong AI correlations, and some of the names like CEG, right? Some various other names in utilities that kind of followed that AI trade. Up at the top of the list, we have consumer staples and healthcare, so more of a risk-off assets. And this is something that we talked about 13 days ago, about 4 or 5 videos ago, where we talked about the correlations consumer staples had to the dollar and how the dollar's big move was really putting the kibosh on consumer staples. But we said that if the dollar starts to roll off, we could potentially see a move higher in consumer staples, even that they're lower beta names. Some of them pay good dividends, so you might be able to get capital appreciation as well as some dividends. And we saw a nice strong move today, 2.71%, which is pretty aggressive move in a consumer staple type trade. What I find very interesting too about all this sell side is looking at high yield. Now, there's smart money, there's dumb money. How you interpret that is fully up to you. But I would like to think that the bond market is much smarter money than the equity market. And looking at HYG being quote unquote smart money, it closed higher on the trading session today. And we didn't really see any sell side whatsoever, even on a gap down of any noticeable extent. So HYG did not respond, even though that HYG has a very strong positive correlation to the S&Ps. If we take a look now at NVIDIA, this is the one that really put the hurt on the market. It was down, right, 17%, even more intraday. In fact, if you look here, it's right at this line. This line is the 200-day moving average. If you scope out, we haven't even tagged that 200-day moving average for 2 years. So it's been a very long time. Now, I know that people are going to want to try to catch bottoms. It's a dangerous business, obviously. But yeah, what do you think is going to happen after moving 17% to the downside? We'll probably see some snapback rallies, but just know when you're in the heat of volatility and you're trying to trade bounces, treat it as such. Make sure your position sizing makes sense for you, because you do not want to see this thing gap down or put more pressure to further downside where you get caught into trade. So you got to be very tactical. Now, why wasn't I trying to catch bottoms in NVIDIA today? If you managed to catch the live stream today, which I do live streams on Twitch right now, I do plan on bringing them back to YouTube. And if you want to get notified, follow me on Twitch and set up alerts, and or follow me on X. And I post when I go live there, as well as in my Discord, okay? Okay, so why wasn't I excited about trying to catch the dip here and catch the dip here and catch the dip there, which I was seeing all throughout social media today? Because if I looked at market net flow, and if you looked at market net flow, it was bearish divergence the entire day. Cumulative net premiums for puts were floating up higher. Cumulative net premiums for calls were going down lower. It wasn't until later in the trading session, while we were on live, where we started to see some bullish divergences start to play out for NVIDIA, where we got this nice undercut over here, and it closed at the high on this 15-minute time candle, which happened to be the local bottom just for today's trading session. And we started to move a little bit higher from that. And yeah, probably in the after hour session, we're going to bounce a little bit more. So yeah, catching bottoms is very dangerous, but if you're patient and you wait to see if divergences start to play, if you start to see the internals start to change more positively, you can create some opportunities, but just be mindful that the risk is still there. So you have to have stops in place. If we take a look at the S&P 500, we saw a big move to the downside and a snap back to the weekly 5 EMA. We got way up here at 61.25-ish, and guess what? We were pretty extended from the weekly 5 EMA. So what did we do? We snapped back right to that most frequently touched EMA over here. When we get big extensions, a couple of deviations from this weekly 5 EMA, it's very typical to see snapbacks. But we're closed. Where did we close? Well, we closed, obviously, we're down on the week 1.46% to start the week, and we closed basically right here just above an inclining weekly 5 EMA with still, obviously, lots of time left in the week. Where do we land as far as expected move? The market was pricing in a decent expected move, over $8 in the SPY for a big week, right? We have Fed talk, we have earnings. I'll go over that in a moment. But what happened today? Well, we started well outside of the weekly implied move. There's always a higher probability that we doodle around this. And we came back in, we touched, we rejected from it. We came back in, we rejected, and then we came back and we closed basically on the weekly implied move, which the lower level here is at 599.56, and the upper level is 1638. Now, if we go to Qs, obviously, because they had more damage done to them, we did not come back to the weekly implied move. In fact, we closed outside of it quite a bit. And you can see going into tomorrow's trading session, we have a pretty large daily implied move of around $6. So there's a lot of volatility still being priced in here for the Qs. Now, I do want to call out a very interesting level here, and that right here is 511.21 in the Qs. That you can see a little LYC. LYC for me stands for last year's close, right? Last year's closing price. So when we crossed under this, that means the Qs were actually down on the year. But we managed to close above it, and we closed above the week-to-day anchored volume weighted average price. On the first bounce of the trading session, look where we got rejected. It was the year-to-date anchored volume weighted average price. So based off of that time weighted average price here, you would want to see obviously price to recoup that, because based off of all the volume from the start of the year, it's telling us that the average buyer would be technically in the red, okay? But the last year's closing price is obviously, we are still positive on the year. So what would I like to see in something like the Qs? Well, I would like to see it reclaim some of these levels. We'll talk about market conditions, but going into tomorrow's trading session, just pay attention to that. I want to hop back over to the SPY and just call out, January has been an insane month. We saw a big move, and where did we come into? We came into creating a high just above the upper monthly implied move. So we're coming into the end of January now, and guess what? The market did exactly what the market priced in, and we're seeing a little bit of volatility take place right now. I don't think it's anything to worry about right yet. I think we just need to tread carefully and be aware to the opportunities that can very well arrive. Speaking of, obviously, opportunities, we're walking into a very volatile trading week. So implied volatilities, they're going to increase, meaning that the market's going to be pricing in more risk, right? That's what it tries to do. Going into tomorrow, we have Boeing before the open, GM, we have Lockheed Martin, and so forth down the list. After the close, we get Starbucks. That's going to be the bigger one to watch. However, the biggest ones to watch, because this is the largest trading week of the year, of the quarter, we have Tesla after the close on Wednesday, and Meta and Microsoft all reporting. The following day after the close, we have Apple as well. So we have the large market cap names coming in for earnings. It's going to be quite wild. I'm going to try to stream those if I'm available. But not only that, okay, that's Wednesday after the close. We got some big names. On Wednesday, during the trading day, we had the Fed interest rate decision. That's Wednesday, January 29th at 11 a.m. Pacific Standard Time. And then we had the Fed press conference 30 minutes later. Now, why is this so important? It's because we now have the first the interest rate decision with a new president in. And there's going to be many, many questions to Jerome Powell and the whole world watching, right? The financial world watching how he responds and reacts to what Trump already said about rates. So how he goes about this is going to be incredibly important and could bring in a lot of volatility if it maybe combats the things that he says. We'll see. My opinion, I think he's a very smooth talker. So when they ask things about Trump, he's going to probably say, well, we try to stay out of politics. We do our best with the data that we have. The data right now is looking X, Y, Z, whatever he wants to say. And we're going to play it meeting by meeting sort of ordeal. And we'll see if he can really kind of word around that, because Trump is very direct in what he was saying. He wants lower interest rates. People are going to ask Jerome Powell, are you going to lower them? He's going to talk about data, okay? They might come back and say, well, the data suggests X, Y, Z. So if inflation is rising, will you be looking to raise interest rates back again? There's so many different scenarios here. So what we're going to do on Tuesday's stock market brief show, or even Wednesday if I can live stream, is we're going to be looking at the expected moves more intently, because it is going to try to handicap the risk, the overall risk, what the market is pricing in. Now, if we look at the direction of the 5-day moving averages, SPY turned yellow today, right? Gap down. We're underneath the direction of the 5-day moving average. Basically says, hey, proceed with caution here. Qs, it is red, and it crossed underneath that year-to-date anchored volume weighted average price. SPY's still holding strong above it. IWM saying caution, it's yellow. Semiconductors was the big drag. No surprise here. It's the AI trade. Got extended. Maybe we see a snapback. If we see a snapback, it's still under a declining 5-day moving average, and it's well under the year-to-date anchored volume weighted average price. So if you do play this, pay attention to those levels, because they can act as potential resistance. You want to see the market kind of heal itself before feeling more confident. So if you're not confident, if the market's not confident, if you are going to play shorter term trades, just make sure your position sizing makes sense, and just make sure that you're a little bit more aggressive and have a stop and a plan in place that makes sense for you. Biotech is not doing bad. We're holding above the year-to-date anchored volume weighted average price for the year-to-date, and we're holding above a rising 5-day moving average. So biotech is kind of just chugging along right here in the current moment. So we can see a potential break to retest these highs. If you are trading this, if it cracks below here, maybe give it some time, maybe a stop under here. If you're trading various biotech names, I would look at kind of how they are setting up on a case-by-case basis. DIA, absolutely just a monster still, right? The Dow Jones Industrial Average, you have 30 names, and Apple made a huge comeback. That's a big weighting. And then healthcare did pretty good today too as well. So yeah, DIA is holding up very strong in this current context. Let's take a look at what is gamma suggesting. So we'll look at a net gamma chart, and you have a call wall. So traders are still kind of focused here at 6,200, right? But on the flip side, traders are focused down here at about 5,800. So downside risk, 5,800. Upside potential, 6,200. What's that look like on a chart? Well, we were here. Now we are here. Where's 5,800? It is down here. Okay, where's 6,200? It's up here. So if we were going to go to 6,200, right, if we're going to make a run for that, just be cautious up in that area, because up in this area, we would be technically above the JPM collar strategy. We came pretty close into it. We came into the monthly implied move, and bam, we started to reject from those levels over there. So perhaps this takes some time to work itself out, to set back up. I don't know. But what I do know is we're below some declining 5-day moving averages. And right now we're below the flip line, and that's where volatility picks up. It's where dealers, they sell into the selling, they buy into the buying. Moves get much more volatile. When things are more volatile, right? This doesn't necessarily mean crash, right? But what it means is you can technically execute into good looking trades that have a good risk to reward, and then they make sense for your style. You can execute into them with less capital because they typically move much more in higher volatile environments, right? I say this very frequently, right? If the VIX is 10, I'm just giving round numbers, trading at 10, and you're used to trading $1,000 portfolio, right? And you're used to the daily swings of a VIX around 10 to 12, and you're totally fine, right? But if all of a sudden the VIX goes up to 20, where the volatility doubles, guess what? Your daily swings of your $1,000 portfolio are going to move double that, and very easy math. So you got to think in terms of higher volatility. If you execute heavier and heavier into it, just be prepared for more whipsaws, and you can very well get hurt in those environments. You can make a lot, but you can get hurt, and you got to find consistency in the way that you trade. I'm rambling on there. Let's hop into some individual names that are setting up. This is not an all-inclusive list. These are some names from my tight list here and some names that I went over on today's live stream. PENN, not much of a trend here, but I just find this setup to be kind of interesting. I think it still needs a little work, but I like this big gap down and the reversal up with big volume. And now price has just been very tightly consolidating under this trend with volume drying up. So to me, I mean, if we start breaking out here soon, today was an inside trading day, I believe. So if we break above the high, maybe I do a pilot position, stop under here, try to target up in these ranges or potentially higher. Another thing that I like about it is the 200-day, right, went from declining for a long period of time, and it's starting to finally turn back up in the near term. So I like the risk to reward. Why? Because, well, risk, you can back into it. If it breaks down, okay, cool, get out. But if it breaks out, hey, the upside potential could be rather nice. Planet Fitness has been on a very, very big run. It broke out of a base recently, and today we came back to back test it. So if we start to see strength back through, we can retarget these highs and potentially higher, maybe 110 in the price of Planet Fitness or more. But right now we're getting a back test of Planet Fitness. PayPal, I took a pilot position in today. The reason why is because we started the day really low, back into an inclining 50 and 20 day, but we started to reverse and close near the highs. So I got into a position right in and around this range with a stop at today's low. And my thought is very simple. We can go retest these highs and potentially higher. And what I like about this is the risk to reward, right? This would be the risk. And then the potential reward here makes for a 1-for-1. And the whole goal is to get a potential breakout. So if we can move up into here and tighten up, that would look pretty good. Now, on the flip side, we do have earnings around the corner. So if we do get a continued move up here, I can maybe reduce the position. That would be about a 4% move to the upside. Or that would give me some breathing room for earnings, right? So if we move all the way up into here and I still have my position, I may be able to hold on to the position because it is just a pilot starting position. If it was a full size, I'd have to reconsider. But that's what I'm looking at there. Got to stop under today's low. If I get stopped out, big deal. It's a pilot position. I'm looking to add more, right? The next one I took a pilot position in is Jets, Jets. Today we had a bullish outside body over here as it pulled back kind of into a prior breakout area. And I've liked the volume on the way up. We've had like pullbacks on declining volume, then a move higher on some, nice little volume there. And then right here, we had a nice little pocket. And price pulled back in, volume kind of dried up. So my stop is a little bit less aggressive than the prior. I think, where did I put my stop? I have to go and check. I think my stop was under this trading low session, which is, man, I wish I remembered. I think maybe 25.68. I think that's what it was. There's a lot of other good names out there. I went over on prior shows like DocU. It's kind of wedging, getting very tight. DOCU. And right, like I said, it's not an all-inclusive list, but while the market is changing as far as these conditions go, we're reaching into some of these key levels. If I start to execute, it's going to be starter positions until the market proves itself, because I don't want the market to keep going down on when I have like scaled up positions, because that hurts my portfolio, right? So if it works, I add. If it doesn't work, I cut. Simple as that. I got to keep it adjusted to what's going on in these markets to make sure that I don't lop my head off and portfolio just smashed. That's all I got for you. Hope it helps. See you later.